Okay, so we have now discussed each of these 4 input elements: contract, market, counterparty, and behavior. There is a 5th, cost, which we don't discuss, and not at this point at least. And now we ask ourselves, how are we getting this data in reality? Now you in the course, you will enter the data manually, of course. So, but I want to give you a little insight, especially also then Yanis. He will show you how the system looks like for the import of data. It's obvious that we cannot type the data in manually in the day-to-day process. So there are millions of contracts, so you would not be able to do that. So you have to have a clever system how to do it. And these are the 4 data sources which we need to start. So somewhere we need the central data store. How is it called now, Yanis? Data Foundation. Same. Data Foundation. So that's where it's going. And we start with contract data. So that's the central piece. Contract data, you must imagine in banks, is stored in many what we call transaction system. A transaction system keeps a transaction. What is a transaction? Your saving account is a transaction. Or your mortgage is a transaction. Or your cash bond is a transaction. Or anything you do with the bank. If you have an option there, it's a transaction. If it's a swap, it's a transaction. And these transactions are kept in transaction systems. The boundaries between transaction systems is not always clear. Some transaction systems might cover a lot of products, some might be very specialized, and some have strange combinations, and some are quite clear. And there are thousands of transaction systems out. Almost every country has its own transaction system. So there's nothing like homogeneous. I think if one system has 40 or 100 customers, it's very successful. It's very successful because in each country, especially the on-balance sheet transactions, they are kept in very localized versions of those transaction systems. What are the transaction systems doing? They help you to manage the deal. They tell you when you have to charge an interest. They tell you when to pay back. They do the bookkeeping for you, or at least they communicate with the general ledger. That is what the transaction system does. And actually, in our analysis, we do the same, but just into the future. So transaction systems are more past-oriented. They tell you what to do today, or maybe in the near future. And risk and financial analysis goes just to the end of the horizon and just continues what those transaction systems are going to do under certain conditions. Let's assume in this case we have several systems. We look at 3. We have a system where we have the bonds, where we have the savings, and where we have the swaps. There are many. Normally, banks have 8 systems, 10 systems. Some banks have 40 systems, 50 systems. Some have fewer. And those who have fewer are not always the best. Often, if they have too few, then you merge too many strange things into one system. You force it into one system. Not necessarily a good solution. 8, I found, is normally a good number. But there's no rule in this sense. Now we go to each of the system, and we sit together with the people of the bank, and we ask them, what is in the system? And they will give us names, like a young people bond, old people bond, middle-aged bond, I don't know what, or a protected bond, or names like that. So, and then you ask, yeah, and how is it really functioning? They say, yeah, we give out money, or we get money in the beginning, we pay interest, and we pay back at the end. So we say, PAM. because that follows that thing. Maybe they might have amortizing bond. So then we will ask, yeah, how do they amortize? Yeah, in a straight line or traditional amortize. Yeah, it's a RGM and so on. So that's the first question we are going to ask. So we make a map and say, in this system, we have PAMs, ANs, and RGMs, just as an example here. And then the next step is to have the rule to know when is a contract a PAM, when is it an RGM, and when is it an ANN. That's the next step. And that's certain characteristics of the contract will tell me that. For example, if there is an attribute which says something about payback, then I know it's not the PAM. Then it's the other one, and maybe some other attribute tells me it's an annuity, and so on. Now, we have these 3 categories, and now we take the first one, say PAM, and say, this is the minimum data list. 5 attributes, 7 attributes, that's the minimum we need. But then we ask further and say, are they always fixed? Are they variable? Oh, there are some variables. We say, okay, there is a subvariant. For variable contracts, we need these attributes. And so on. So you come with the list of the attributes, and you do that by normally having some kind of ETL, some extraction tool where you do that. So there you check all the rules which you have. And you end up with a list of data. Here, validate, maturity date, principal, etc., whatever the list is, for each of the contracts. And you take that into the system. You load it into the system. While loading, there's of course a lot of checking happening. And when you do that the first time in a bank, 90% of the deals are rejected, roughly speaking. And of course you find quickly 4 or 5 errors, and maybe the rejection goes down to 10%. And then it becomes tougher to find. And why are they rejected? Because they have internal logical inconsistencies. And you find a lot of bad data in banks. For example, a classical logical internal inconsistency is if maturity date is smaller than valid date. Say, cannot be. A contract has to start first to end. This kind of condition. So you're not going to accept that. Throw it out. So that's the first data. The second data is market data. Now that's much easier because there are, I think, 2 or 3 sources of data for market data in the world. Reuters and Bloomberg. I don't know whether Telecore still exists or something like that. Maybe there's a third one for certain data. And they all are very, very similar. Take that in. The third source is the counterparty data. So there you have internal data. Internal data is now the descriptive data of the people, name or turnover for insurance, for companies, etc. ID, the ID, of course, very important. Then external data is scoring, stuff like that, and hierarchies. So who owns whom? These are the 3 main sources. It used to be 10 years ago, maybe 15 years ago, that banks had several counterparty systems. These counterparty systems came with the transaction systems because, let's say you had a saving systems, and often in the saving systems you also had a system about the counterparty, who saves. Then you had a bond system, and they also had a counterparty. And of course then things become muddy. The same person you have twice in the system, and you might not know it. You might have a little misspelling or whatever. You even cannot really match them. So, but this most banks have got rid of here now. So normally there's one source of counterparty data in one bank. So that's why the case is easy. You go to this one source, and you pull the data. So now you have a nice string of data. And here, there is already an additional step often. It's the scoring or rating. That happens normally at this step, so where you have certain rules depending on that kind of data or on that data, whatever you have, which then gives you a rating here. So now we have 3 sources of data. And we are in RiskPro. So while doing that, in RiskPro, we work in structures. And often banks work in balance sheet structures. So the data is organized according to a kind of balance sheet, which is close to a balance sheet. This is a very good way of doing it because everybody knows the balance sheet. You know the numbers of the balance sheet and so on. So say, organize the contracts according to the balance sheet. So if something is a saving, it should go to the item savings in the balance sheet. And if it's interbank, it should go to interbank. So how do you do that? By looking, now we have contracts. And here is a balance sheet. So you look at the contract, and there you always will find the information on the contract, which determines whether something is a saving or an interbank or a loan or whatever. So depending on that, so you do the selection part. So it goes to the right structure. And you will see today and tomorrow that much of the analysis starts by first defining a balance sheet. That has partly to do with not optimal architecture of the product, I can say. On the other hand, you need anyway such a structure. Otherwise, if you don't have a structure, you would have all contracts on one big heap. And you don't want to look at all contracts. And the balance sheet gives you anyway a first primary structure. It's helpful to understand what you have. So that's fine. But so the first thing you have to define when you do a model is such a balance sheet. But remember, that's only an organizational thing. Don't think it's so important. What really is important, that is what happens on the contract and on the other risk factors. And the balance sheet is only an organizational thing. Now, in reality, we often do also an aggregation. Now, in your case, you will not do aggregation because you will start with aggregated data because you will enter data manually. So your data is highly aggregated. It's already a big aggregation. Now, in reality, we have millions of contracts, and depending on the type of analysis you're doing, with millions of contracts, even if you have the best machines, it can take a long time. And sometimes, especially if you know where you're going to, then you can aggregate in a clever way. So you always have to aggregate in a way that you don't kill what you want to look at. Don't aggregate away what is important for you. And there's a routine which helps you to do that, so that you can keep the focus. But important also here, aggregation is a part of the analysis. In banks, it's often different. Aggregation is somewhere out in the IT department. And you get it already aggregated and you don't know really what has happened. So here we get single contract, and the aggregation is the first step of analysis. That is just to optimize it. For example, if you do Monte Carlo value at risk, so you wouldn't like to work with millions of contracts. It would be an endless calculation. So having that, we miss only the last element, which is the behavioral part. And we said already, behavior has a lot to do with statistics, with it's not well-structured data. All the other data is very well-structured. So if you have the data, basically you have the result. Here, you have to think yourself. And of course, you can make big errors. You have to be very careful. So here, the real expertise then comes in. There's also a lot of expertise up here. Here you can make the error in data. So if the data is already wrong, of course, all the results are wrong. But here you have to define the data, more or less. So the behavioral assumptions, these are functions which then affect those contracts, especially those contracts, and the corresponding results. Having that, So we do static analysis, and static analysis are all these 5 elements: liquidity, value, income, sensitivity, and risk. So that's all that. And in static is like the upper left, the number, the Roman 1 type of analysis. That can normally be done once you have defined all the data. It happens overnight. You don't even interfere with it. Everything is predefined. So that is what you have every morning on the table. There are even predefined shocks. You know, you have certain shocks which you always want to calculate, and you get the result of that. Nothing to do, just a lot of computing overnight. Yeah, the computing also, it's very tough. Normally, you get the last data something like morning 2 o'clock or 4 o'clock, something between there, because all the transaction systems have to have done their jobs before. So especially up here, the job has to be done here first. So it's maybe 4 o'clock, and about 9 o'clock you need to have your result. That just tells you how many computers you need. The whole thing is, of course, is highly parallelized, so you can increase the power by adding more CPUs. And it's highly efficiently written, highly efficiently, so that it's very fast in calculation, that it can deal with millions of contracts. So that's static analysis. Then dynamic analysis, that will need more input here, because now you have to define your new business. And dynamic analysis we will only see about after 5-6 weeks. But you have to consider it now already, because some of the tasks which you will do are dynamic of nature. And then there is a final step here, the historization. So keeping everything in a nice order. If you look at the 3 external data sources and the efforts banks are doing, market data takes you 2 days of work because it's more or less defined. You just have to put the right RICs, or whether they're still called RICs, I don't know, but the right pointers to the right, and you get your feed of yield curves, FX rates, whatever you need in the system. So that's nothing. Counterparty data takes you maybe 10 days. What would you say? Maybe in your... Oh, okay. 1 month now. Okay, but depending on the how people work. Say a month, would you agree with that? Okay. Say a month. Now, assuming there's only one system where you have to get the data from, here. Because that data is easy. It's nothing to transform, and it's already in the form where you want it, like a name. A name is a name, and not really to transform. Yeah, sometimes we had the problem with other alphabets, like Greek, Arabic. So you're getting problems there, but that's solved now with the 64-bit stuff, I think. It should be not the problem. You can have it in any language you like. But that's more or less moving data from A to B. And it keeps the same interpretation, the same logic. There is only one, it's a descriptive logic, so it's not really difficult. This, I have seen happen, this takes between at least about 4 or 5 man-years to about 100 man-years. I think 100 is about maybe the biggest I've taken. So imagine 50 people working 2 years. So everything else is peanuts, actually. It doesn't matter. Now, why does it take 2 years here? 50 people, I mean 100, that's the extreme case. But 10 man-years easily. What's the problem? There are 2 problems. First of all, dirty data. That, I think, is 80% of the problem. Data is horribly dirty, normally found in the banks. And the second part is you have to translate one logic into another logic. That's a difficult problem. Like if you have to just to translate a data, let's say data can be, the dates can be day, months, or year, months, and so on, you know. So that's That's a peanuts process. But here, because each of these transaction systems up here, they also have a transaction logic. They think in transaction, they think in contract types, really, not expressively, so halfways. But in reality, they think in contract types. But every bank and every system has its own contract types. And so they have their own logic. And then here we have one logic, which is then for all these systems the same. But that means we have to translate this logic into that logic. And the translation of logic is much more tough to do. So it's a more difficult task. But what we end up down here is with one single logic throughout the bank. Because now, even inside the bank, you have several different logics, which banks cause a lot of internal problems. So a lot of the analytics goes into just always figuring out which system is it coming from, how do you have to understand, how they interpret it like that, like that. Take only one easy, though still difficult problem, signs. You can define an asset to be positive and a liability to be negative. But many systems declare assets negative and liabilities positive. That's just the way you look at the thing. It both is valid. Those who define it negative, they look backward. They thought we paid for it, which is negative. Those who define it positive, like in the risk management, they look forward. They say, oh, we will get cash. But it's one or the other. So it doesn't matter really. But in two different systems, you have already often two. And sometimes you have within one system already two systems. That happens as well. So these are the problems you're facing. And then you're not dealing on single attribute on single attribute. It's a whole collection of attributes which together define the code how you exchange cash flows. So you cannot really single out only single attributes because they always interfere. Like principal, you need when you calculate principal payment, but you need it also when you calculate interest payment. So it's not in one direction, it goes in many directions, and you always have to be careful where it takes. So transforming logic into logic, that causes the problem. That's why you have much more time here. But 80% of the problem is dirty data. And this system is, because we have to do all the analytics, so we cannot live with fuzzy logic. We cannot live. Oh, if you would have fuzzy logic, maybe yes, but then still it's defined. We cannot live with an undefined state or an impossible state. So we have to throw everything out, which is a superb cleaning process. I had banks, they told me, only for doing this, only for cleaning that data, the whole project would have been worthwhile already, because it has positive effect in many other directions as well. Yeah, so much from my side, so that's the reality you're working. We just wanted to tell you that you have some link to the real world outside. So your world will be much more cozy. You will control it. You will enter the data. So if you have wrong data, you have done it. And you have to correct it yourself.